Hello again, this is Terry Price, and welcome to the next chapter in our series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. I hope you enjoy. Welcome to the fourth chapter in our series covering the changes enacted by the Tax Cuts and Jobs Act of 2017. This chapter will cover home mortgage interest. If you will be itemizing your deductions this year on Schedule A, the home mortgage interest deduction is claimed in the section entitled Interest You Paid. First, let us define what is considered a home mortgage. A home mortgage is any loan that is secured by your main home or second home, regardless of how the loan is labeled. It includes first and second mortgages, home equity loans, and refinanced mortgages. Now, what does the IRS consider a home or second home? A home can be a house, condominium, cooperative, mobile home, boat, or similar property. It must provide basic living accommodations, including sleeping space, toilet, and cooking facilities. Sounds like a camper, RV, and timeshare would be considered a second home. So based on the definitions, you may have a qualifying home mortgage loan, but that does not mean the entire amount is qualified for the interest deduction. Let's review the rules about the amount of the home mortgage loan that is eligible for the interest deduction. If the loan was taken out after October 13, 1987, the amount eligible for the deduction is the amount that was used to buy, build, or substantially improve the home. If the loan was taken out on or before December 15, 2017, the amount eligible for the deduction is limited to $1 million or $500,000 if married filing separately. This limit is a total for all loans considered for the deduction. Therefore, if you have multiple loans on your home or have loans for a second home, the total amount eligible for the deduction is $1 million. The change from the new law is if the loan was taken out after December 15, 2017, the limit has been reduced from $1 million to $750,000, or $375,000 if married filing separately. Also, the amount that is eligible is limited to the fair market value of the home. So, the total amount of loans cannot exceed the total fair market value of the homes used to secure the loans. To calculate the deductible mortgage interest, first you determine the eligible amount of the loan from the criteria above. Then you can deduct the interest that was paid on that amount. Home equity indebtedness is the amount of a home mortgage, second mortgage, or equity line of credit that is secured by a home but was not used to buy, build, or substantially improve the home. The new law suspends this deduction beginning in 2018. Therefore, it can no longer be deducted. The key is the use of the proceeds of the loan. If you use it for the substantial improvement of the home, it is deductible. Otherwise, it is not. Let's look at some common examples. You refinance your mortgage to consolidate bills or credit cards. This can be a very financially smart thing to do, as it usually will lower your monthly payments and move some of the debt to lower interest rates. However, this does not make all the interest paid deductible. Only the balance of the current mortgage at the time of the refinance is considered eligible for the interest deduction. The additional amounts financed to pay off the bills and credit cards is not eligible for the deduction. Back when the IRS eliminated the deduction for personal interest, equity lines of credit became very popular. It allowed you to deduct the interest as mortgage interest no matter what you purchased. But as we previously mentioned, home equity indebtedness is no longer deductible. So we must analyze what the proceeds of the equity line of credit was used for. It must be used to substantially improve your home. And by your home, I mean the property that is used to secure the equity line. Which brings up the third example. You take a second mortgage or equity line on your home and you purchase a second home, such as an RV. Normally, this would qualify as it was for the purchase of a property that qualifies as a second home. However, the proceeds must be used for the property that is securing the loan. Therefore, if you plan to purchase a second home, make sure the new property is the collateral used to secure the loan to purchase. This will allow the interest to be deductible. If it is not the way you have things financed currently, it can be fixed. If you take out a new loan against the second home and pay off the purchase amount from the original loan, then it will qualify moving forward. We've been throwing around the term substantial improvement quite a bit, so let's see what that means. Substantial improvements add to the value of your home, or prolongs the home's useful life, or adapts your home to new uses. Add value to your home could be solar heating or a pool. Just don't tell my wife. Prolongs your home's useful life could be replacing your shingled roof with a metal roof. Adapts your home to new uses could be adding accessibility features such as lifts and ramps. General maintenance to your home is not substantial improvement, no matter how expensive. If your furnace goes out and you replace it, that is not substantial improvement. Nor is replacing the shingles on your roof with more shingles. If your loan turns out to be limited, you can use the worksheet provided in the IRS publication 936 to calculate your deductible mortgage interest. There will be some math involved, but the key is for you to know what you use the proceeds of your loan for, especially for any refinance mortgages, second mortgages, and equity lines of credit. I know this may seem a bit confusing, but your tax preparer should be able to walk you through it. Thank you for watching this chapter covering home mortgage interest. We greatly appreciate your time. Join us next time as we will be covering charitable contributions. Thank you. For more of this video series covering the Tax Cuts and Jobs Act of 2017, be sure to follow us on Facebook. You can find us using @TerryLPrice CPA. For previous chapters of the series, go to www.terrylprice.com/CPA and click on videos. There you will find all the previous videos. If you have questions, please email us at cpa@terrylprice.com. Please do not post tax questions as a Facebook comment. This video series is to provide some basic information concerning the recent changes in the tax laws. This is not to be considered tax advice. Please consult your tax preparer to analyze your individual tax situation. Thanks for watching.